Some of my investors always get like a money partner and then they put a lien on the property. Usually you can't do it on these. So you got to be strategic if you're raising capital for these deals, because quite often you're not allowed any subordinate financing. So you can't have a gap funding partner fund the down payment.
Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. And now, your host, Bo Eckstein.
And today, I put this PowerPoint presentation together as I'm helping a lot of clients that are buying short-term rental properties, trying to figure out, some avenues to finance these properties in different markets. I have a lot of clients in the Smoky Mountains and also Florida is another hotspot, some different parts of Tennessee, obviously California and multiple other states. So really, we're going to kind of dive in and just give you the options that are out there for short-term rental financing and dive into it. So let's get started here. Just a little bit about me. My name is Bo Eckstein. My company's called Emerge Lending Group. I'm also the managing director of Pace Equity. We provide C-PACE financing and a lot of development loans for hotels, multifamily, industrial properties. And that's in about 25 states. It's a very good tool if you're doing large-scale developments. I'm a California licensed broker. I'm licensed in a few other states. Volunteer mediator. I have a podcast if you're not familiar with it. And then also, I'm a co-founder of findthebank.com. And that is it's kind of like the lending tree, but for commercial real estate. So we work with banks, credit unions, debt funds throughout the nation, and have kind of found a niche working with banks and credit unions that are not mainstream, but yet might be a $7 billion credit union that does $30 million loans and can do construction financing. There's over 20,000 small, regional, local banks and credit unions. And so we've had a lot of success networking with these bankers and developing relationships in different markets throughout the nation to provide financing for our clients for their needs. Yeah, right. So what we will be covering today is some recent closings, basic questionnaire, bridge renovation loans, seasoning requirements, portfolio loans, underwriting guidelines, why and when a bank loan might be your best choice, projected based portfolio loans versus short-term rentals, blanket loans, building business credit, financing furniture and fixtures, Q&A. If you guys have any questions, you can feel free to put them in the chat box and I'll get to them. I also have a couple questions that were emailed to me, so I'll address those as we go. So here's a recent closing. Actually, this is slides wrong, but a contact of mine is a fix and flipper and also an STR, short-term operator in the Tampa market. And this one was actually 4 single-family homes, which were Airbnb properties, and he also had a duplex. So there was a total of 5 properties. The duplex was a long-term rental. So they were all free and clear. So good for him for having that much equity. And what we did is we did one loan, portfolio cash out to 65% of the value using the short-term rental income and the long-term leases. He easily qualified from a debt service coverage standpoint. So that was a pretty fun deal to just be able to offer a blanket or portfolio loan on multiple properties at once, one loan as opposed to having 5 separate loans. Here's another property that I just recently financed about a month and a half ago. And this was 9 bungalows on one lot in California, Northern California. Gentleman owned it, was looking to do a cash out refinance. We were able to negotiate a really good deal with the credit union, delivered terms in the 3s, no prepayment penalty. A lot of times I like to work with credit unions because I can negotiate no prepayment penalties. Most credit unions don't typically put prepayment penalties on, so that's an advantage of working with credit unions. And we've really kind of identified a lot of good national and local credit unions to work with who oftentimes have the best rates and terms out there, period. My buddy John was buying a 20-unit multifamily property, and Fannie and Freddie for multifamily have requirements of owning multifamily to qualify for their financing. He owned 1 to 4 unit properties, but didn't own any commercial properties. So we were able to find a credit union, local credit union, deliver 80% of purchase price with a 10-year fixed. I think the rate was 3.5. So no prepayment penalty. That was even better than what Fannie and Freddie could do. So we have all these solutions. It's just a matter of figuring out what makes the most sense. A lot of times, what's been happening recently is that I get a call from a borrower, and all of a sudden they can't get bank financing. They're trying to go the conventional route, or sometimes they're going with the commercial division of the bank, and they were quoted 70-80% of purchase price, and then the bank's coming back and saying, "Oh, we can only lend 60%." And then all of a sudden, I save the day. I come in and I do bridge financing, enables them to close on the transaction, build their, get the property on Airbnb, build a track record, and then refinance out of that. So that's sometimes what I'm seeing a lot of times right now, is that because there's not a consistent level of underwriting standards for short-term rentals, we're running into issues when people are trying to acquire these properties. And right now, in a lot of these markets, the price points are extremely high. In like Tennessee, for example, if you look at like what properties were trading for 4 years ago, they've doubled in value from like 3-4 years ago. So we're seeing a lot of problems with bankers and so forth. Not that the properties won't appraise, but it's just that getting them on board and feeling comfortable using projection-based income from these short-term rental properties. And that's kind of where our niche is that we have a product that's a non-bank product that we use projection-based revenue. And here's a property that I funded last month, off-market deal. The sponsor had the purchase price at $229. I gave him a 75% bridge loan. Rate was 8.25. It was a 12-month bridge loan. Anyways, he ended up basically cleaning it up and putting it on the MLS, and he sold it for $365. So he made way more than 50 grand. Anyways, so that's another reason why you want bridge financing, because if you're going to plan on flipping or doing some value add, you might want to go the bridge funding route as opposed to a conventional loan, because you're going to increase value. This was just a smoking good deal, right? Like he just found a great off-market deal below comps and took advantage of that. Here's another property that I just financed last month, 98-unit multifamily bridge loan. So this was a value add deal. The sponsor's biggest project to date. It was a $4.5 million acquisition price, and we were able to do 80% of purchase. He raised the additional capital through a syndication, and it was nice helping somebody grow their portfolio. The biggest property they had, I think, besides this, was a 13-unit. So we created a strategy. He's already making great progress, and we're going to look to refinance this into a bank or credit union very quickly. So basically, we do all sorts of financing, not just short-term rental, but I think I have a good insight of what's going on in the market for all different types of properties. And there's some operators that I know that are buying small multifamilies and converting them all to short-term furnished rentals. So that's just another strategy that I'm seeing. If you guys want to, after this call or in the future, if you want to bookmark this site, if you go to strlending.com, it takes you to my Bo Eckstein website, but it's a special page, and it's a basic questionnaire, which is the questions I need to do some pricing, some initial indicative terms on your loan request. So if you have a loan that you want some quotes on, you can go there. And you can also see that there's a calendar link. You can click on the Meet with Bo, schedule a call at your convenience, and we can discuss your financing needs. A lot of my clients are newer. And a lot of my clients are very experienced. So I'm able to help clients that maybe have a couple properties scale their portfolios and get more properties by, creating a kind of a strategic financing plan, how to leverage what they have, how to leverage their new acquisitions and keep growing their portfolio in a strategic manner. And you'll see this is just a screen capture of the questions I need, and you can actually upload documents right here. And that just helps me do a quick pricing for you. Really, when it comes down to these non-bank loans, I'm able to place credit union and bank debt too, but for these non-bank portfolio loans, it's really credit score, LTV, purchase, cash out, refinance, rate, and term refinance. That's how we figure out pricing. It's got to meet debt service coverage requirements, which we're going to get into in a little bit. So that's the questionnaire. Then we're moving into bridge renovation loans. So on these type of properties, it's very easy. It's really, it's basic. And really what we want to know is, what's the property address? Is it in a very small rural area? Is it a large MSA? What's your experience? How many flips have you done? How many rentals do you own? What's your credit score? And what's your loan to cost requirements? Are you trying to borrow 80%, 85% of purchase and 100% of the repair cost? If it's in a rural or small market, our leverage is less as opposed to if it's in a major city, right? It's just easier to get higher leverage in bigger markets, which makes sense. And also how fast you need to close the loan. Depending on where it is located, if it's a larger MSA, we can close deals in 7 to 10 days if needed. 10 days is right now is probably more realistic. We do have to do an interior BPO or appraisal, depending on the lender we work with. But 10 days is the 7 to 10 days is the fastest, and that's only with certain partners of mine. If you're trying to really maximize leverage, those deals typically take about 20 days to close, 14 to 20 days, just depending. It's really scenario based. But these loans are great to, a lot of my clients are going in and they're doing kind of BRRRR to STR, I guess. They go in, they find a fixer, like they would almost size it up as a flip, but it would make a great STR. They go in, renovate, furnish, and then get it listed on their platform, Airbnbs and VRBOs and their own websites if they have them. They build a track record. There's a lot of options once you have the income reported on your tax return. You can then start using conventional products if you want to finance the refi. But quite often, most of the investors I see don't really want to deal with conventional because maybe they have too many properties. They have DTI issues, meaning debt to income problems. And so that's why we're starting to just do a lot more of these portfolio loans. The rates are based on LTV. So if you're trying to maximize leverage, the rates are a little bit higher than what you're going to see from a conventional standpoint. But we're not asking for tax returns. You don't need to really verify as much in reserves. I mean, if you look at Fannie Mae guidelines on an investment property, for every investment property, they want to see 2 months of PITI and 6 months of reserves for the property they're buying. So really, you'll need a big nest egg in your account. And some of us don't have those available. So we're leveraging. So that's another reason why these portfolio loans are great, because you can buy them in the name of your LLC or business entity, and they don't show up on your personal credit report. Sure, we pull credit in the background check, but they don't show up on your personal credit report. So a lot of people right now too, these portfolios became more mainstream. Right now, it's an asset class itself. Like before, you'd see these portfolios, but now they're easier to finance. You can get loans to finance an acquisition of 30 or 40 rental properties, or to refinance 30 or 40 rental properties. So Adele asked, do you do cash out refi to long-term 25, 30-year fixed rate using value based on STR income? If yes, please explain your qualifying process, LTV, cost, and rate. So yes, we can do either projection based on acquisition. The majority of lenders out there, as far as I'm talking non-bank lenders, if you have 12 months of operating history and you can verify through like VRBO or Airbnb, 12 months of history, we can use that for qualifying. And we look to do a 1.25 debt service coverage ratio. And I think we're going to get that to another slide. But these loans are all based on loan to value, credit score, whether it's a purchase, cash out refinance, or rate and term. That's exactly how we price all these out, and they have to debt service. So if you have 780 credit scores or better, or 750 or better, that's like the top notch credit, right? There's these buckets for credit score. So 720 to 750, you have a certain credit score. 750 and above, you get the best rates. There might be an eighth difference between 720 to 750. Anything under 720, that's going to affect you by an eighth, so 700 to 720, that could be an eighth to a quarter difference on rate. So that's how we price. So we always ask, what's your credit score? What's your middle credit score? So we're going to talk about this later, but that's also the thing. As we're doing a lot of deals, we're getting a lot of credit pulls. We're utilizing maybe some personal credit, where we got to keep in mind to keep our utilization at 30% or less, right? Because if you're starting to use a lot of credit card to furnish these rental properties and you're not paying it down, your credit score is going to be majorly impeded. So you got to play the game. And I think we're going to talk about this in a little bit about building some business credit and the advantages of doing that. So Adele, to answer your questions, it's LTV based, credit score, cash out, rate, term, or purchase is how we determine the pricing. Lenders have different pricing. Obviously, you can go to lender A versus lender B versus lender C. What I do successfully is I know how to get the best rates based on the current scenario. So I usually can beat most pricing out there. I can't always win on best pricing. And you know what? Sometimes surety is the number one thing where we're going to get this closed. We're going to get the deal done. There's some lenders out there, they might quote good rate and term, but it's like you're never going to get to the finish line. It's like pulling teeth. So the way I look at it, especially with these bridge loans, I've done some loans personally where I was doing some fix and flip loans and some rental portfolio loans on long-term rentals. And it's like a crazy process. It's taking like 50 days to get to the finish line. And I'm like on top of getting my conditions. So it's really navigating and getting the right loan. An eighth in rate really to me is barely anything. If you really look at the difference of payment, it's really about getting it done and the surety of getting it done. I know we all want the best rate in terms of price. I get it. I'm a consumer too. But usually I am very competitive and I can deliver better terms just because how I position myself is that I'm a correspondent lender. I also broker some of the loans, and I also broker loans to banks and credit unions. So I have relationships with these small regional local banks and credit unions, and I'm able to speak banker with the commercial banker and get some of these commercial deals done where somebody going to the bank might not be able to get the right person. Because a lot of these markets that you're buying in, you're not buying it with a residential mortgage broker type loan. It's actually a commercial product for these STRs. So lots of ways to finance them. And we just try to figure out the best way of financing them with the least amount of headache.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Are you in the market for a commercial loan? Did you find the perfect opportunity but need funding? Have a special situation? At Find the Bank, you will get quotes with competitive rates and terms from multiple lenders without any hassles. Have a multifamily property, construction project, owner-user property, industrial, mixed use, hotel? At Find the Bank, you can get nearly any kind of commercial financing. The process is simple. Once you send us some information about you and your property, we send back a quote sheet. Then we quickly connect you with an advisor. You won't spend hours calling multiple banks trying to find the right person to talk to. We'll connect you fast to the right person, hassle-free. Better terms than you could get on your own. Go to findthebank.com and complete the form. An advisor will be connected with you within minutes to discuss your specific financing needs.
Here's a big question here is seasoning for cash out refinancing. So let's just say you go in and you're doing a value add deal, you're buying a fixer, and then you're going to turn it into a long-term or an STR. What are the seasoning requirements? A lot of the non-bank portfolio lenders, along with banks, credit unions, some of them are just strict on their guidelines. We will not let you use new appraised value until the 12-month point. We'll just go strictly off LTC or loan to cost and give you a percentage of loan to cost. I have some portfolio lenders that I work with that will do 6-month new appraised value, and they'll put no overlays on that. So if you bought it for 200 and you put in 50 and now it's worth 450, at month 6, we get it appraised at 450. We can do a 75% cash out refinance. So that's big. I do have some lenders that will do like a 90-day, but they'll do a 5 to 10% haircut on LTVs. So they'll let you do new appraised value after 90 days, but they'll put a haircut on you and do a little bit cap on what you can do. So I always tell people, look for the 6-month mark. It usually makes it easier for new appraised value. This is good because most of the investors out there are doing some kind of burst strategy, because that's where we can kind of leverage our funds. A lot of people want to put the least amount of down and then maximize on the refinance, get all their proceeds back. I mean, that's the idea of BRRRR. Go in with as little as possible, refinance once the property is stabilized, and pull as much equity, if not all equity out, right? Ideally, if you can do that, that's a great BRRRR. And then you take your initial seed money and then you do it again and again and again and again and again. And it's unlimited how many you can do that way. If you have a lot of cash, you're not as concerned usually on these strategies. Sometimes people want to keep the loan to value at 65%. Some people want to try to get 75% out. So to answer the question here, each bank lender is a little bit different, but for these non-bank portfolio loans, just look for 6 months. We can use new appraised value with some of the lenders, which is pretty good. Others are at 12 months, but they can do a percentage of loan to cost. I do have one lender which does a niche product, which is kind of cool. So we talk about delayed financing, and delayed financing is where you pay cash and then you document your costs, and then you're able to do a cash out refinance to recoup the money, and you can go conventional with that type of product. It's called delayed financing. So borrowers who purchase a subject property within the past 6 months, measured from the date on which property was purchased to the disbursement date of the new mortgage loan, are eligible for cash out refinance if all the following requirements are met. And there's a whole checklist on this, but this is something you might want to investigate. And what I'm going to probably do is put together a white paper on all this stuff, because there's a lot of nuances to these rules. And generally what I'm finding, and I don't do conventional, I am licensed, but I don't typically do residential conventional type financing. My business is all commercial and investor type loans. But I understand as you're growing your portfolio, if you can leverage traditional financing, sometimes it is beneficial and the rates are better and so forth. Most of the investors I'm dealing with now are at a point where it's really not feasible. They have a lot of write-offs from all the assets they own. They show, and maybe a loss on their tax returns because they're accelerating the depreciation. And so they don't mind going the non-bank route and understand that the difference in rate is nominal when you really look at it, and it's less red tape, less headaches, etc. Right now, to do these projection-based acquisitions, they're taking about 35 days. So that's why some people are like, I got to close. We close with bridge and then we refinance down the road. That's the only way around. You're not going to get these portfolio loans done that quick. So I want to set those expectations up front. That's one way to do it. And oftentimes these STRs are the cash flow is so good right now. The difference in payment, let's say it's a $500 or $600 a month difference in payment by using a bridge loan to acquire the property. At the end of the day, isn't a really big deal because these properties are, doing really well in this market cycle. And oftentimes you can get a little bit higher leverage doing these portfolio bridge loans to take down the properties. So let's talk about portfolio loan advantages. Loan is made to your business entity, not you personally. Doesn't show on your credit report. No tax returns needed, no DTI requirements, because on conventional financing, they use 75% of gross rents. Less red tape, unlimited capital, easier to burr properties. Multiple owners can own property. Anybody that owns 20% or more of the entity needs to go on the credit report, or excuse me, needs to go on the loan. And they need to go on the loan, and the loan is made to the business entity, but anybody that's 20% owner or more signs as a guarantor of this loan. That's how all these loans are. There's always a guarantee. There is some non-recourse debt out there for larger properties like multifamily and different stuff, but these portfolio loans are all recourse, which in my mind isn't a big deal because we shouldn't be buying properties that are risky. So recapping portfolio loan advantages, there's a ton of advantages. And I like the fact that you could potentially have a business entity with maybe 5 or 6 cash flowing assets, and you can sell that package to an investor, based on cap rate down the road if you want, which will make it easier. And then you can 1031 your proceeds, or you can potentially just do one at a time. If we do a blanket loan, we can also put a partial release clause, meaning if you have like 10 properties and you want to sell one, there's a release clause that you have to pay down the loan by X when you release that property. It's called a partial release clause. General underwriting requirements for portfolio loans. And this is what the debt service coverage ratio looks like. So most of the banks, credit unions, and non-bank lenders, they want a 1.25 debt service coverage ratio. And essentially what that means is income versus debt, that the income can pay the debt by 125%. And that's what they're looking for these long-term rental loans. Now, for example, sometimes you're doing a value add deal on like a multifamily, and that's why we would go into a bridge loan if the debt service coverage wasn't there because you're doing a value add. You need to make the property go stabilized. So why and when a bank loan might be your best choice. Slightly better rates, higher leverage sometimes, not all the time, no prepayment penalty. Like I said, these portfolio loans are true commercial loans. So most commercial loans do have prepayment penalties because it's a way of the lender or the investor, having a certain yield on the money they lend out. Essentially, that's why they put a prepayment penalty. Oftentimes, these portfolio loans have a declining prepayment penalty, which we say is a 5, 4, 3, 2, 1, meaning if you refinance the first year, it's a 5% penalty based on the principal loan amount. Then year 2, 4, year 3, 3, year 2, 2, and 1. And then after the 5th year, it's no prepayment penalty. There are options to do a 3-year step down or declining prepayment penalty. It's just the cost of capital is a little bit more. So you're paying for it one way or the other. But if you have a situation where you're going to be flipping the package, let's look at different options. I can sometimes do a 2-year bridge loan. And sure, you pay a little bit more, but you're going to exit the property in a year and a half and so forth. So there's different options, but just know that generally when I'm pricing these loans for you, it's going to be a 5, 4, 3, 2, 1, unless I'm pricing it with a bank or credit union. Banks typically have a 5-year prepayment penalty, but credit unions oftentimes don't have prepayment penalties. Once in a while they do. Projection-based portfolio loans for short-term rentals. Debt service coverage ratio is calculated on projected income of your short-term rental. So how do these banks or non-bank lenders do this? They're using their own kind of proprietary AirDNA, AirDNA or Mass Advisor. They have their own formula of figuring out, they're going to ask you, the borrower, what your expectations are for annual gross rents, what your occupancy levels are going to look like. I'm sure you guys are using your own tools and so forth to underwrite this. They're using their own tools to just verify, yes, I believe what you're saying to be true, and it meets our underwriting thresholds. And we'll use that projection-based number to figure out debt service coverage ratio. Then we ask you what the annual taxes are going to be, what the annual insurance is going to be, and that's how we calculate debt service coverage ratio. Loan to value on purchase of these projection-based loans are up to 80%. If you have good credit, you can get 80%. If your credit's marginal, you're probably more like 75. And if it's poor credit, you're probably like, if it's too poor, you're not getting a loan. But if you got 680, 670, 660, we could probably get you 70 to 75. On cash out refinance, typically you're at 75%. Price is based on credit score. There are some interest-only options available. No DTI requirements. So some of these loans do have interest-only options, and that might be not on the 30-year fixed product. So these portfolio loans sometimes they offer a 5, 7, and 10-year option. Each lender is a little bit different, but really the average person doesn't hold the property 30 years. As many people always want 30-year fixed. I get it. It's a safety. We're at an all-time historic low for rates, but the average person sells or refinances. I think the number is like 7 years or less. And lately people have been refinancing every year because rates have been dropping, but there are interest-only loans available. There's also a non-QM program that's now on investment properties. You can do a 40-year term, and I believe that it's interest only for the first 10 years. So this is reminding me of the loosening of what happened in 2005 through 2007. These non-bank or non-QM type lenders are coming up with some creative products to meet the needs. And some of these lenders don't even have a 1.25 debt coverage requirement, which is interesting. Let's talk about blanket loans. One loan could be secured against multiple properties. Potential to refinance properties out of your name into an LLC. Let me unpack that a little bit for you. Let's just say you have 7 rental properties in your name and you want to free up space so you can go buy more properties. Sometimes we take those 7 conventional loans and refinance them into a portfolio loan into your business entity, and frees you up from a DTI standpoint to some degree, because your tax returns are still going to be on your personal tax returns. So it's a little bit of a gray area on how to structure, but that's an option to free up some space. We always want to know what the partial release clause is. If you got a portfolio of 10 properties, if I want to sell one down the road. So each property is allocated a certain loan amount. And then usually on a partial release clause, let's say this $200,000 property has an allocation of, or let's just call it a $100,000 property has an allocation of $70,000. Sometimes the lender says to release that property, we need to pay down of 120% of the allocation. So you just need to be aware of what that looks like if you're going to liquidate properties. And also these blanket loans typically have a 5-year prepayment penalty. So you just need to be aware of what the rules are around that. Building business credit. This is a great tool, guys. If you have a business entity already, there's formulas to get business credit, which is not showing up on your personal credit report. I know I probably have about 100,000 credit that's in my company's name that doesn't show up on my personal credit report. And the reason I like to really focus on building this is because if I buy a property and I'm furnishing it or doing some renovations and I need some capital, if I go and charge up a bunch of my personal credit, and let's say I have a $20,000 high credit limit on this card, and I go and charge up $17,000, it's going to dramatically drop your scores, dramatically, unless you're paying it off that month, right? So business credit is key. I think I've done some, if you go into my investor financing podcast, you can find some discussions we've done on building business credit. And there's a whole formula to start with gas cards and this and that, and then you can build, your business can actually have a credit score just like you do, but it's a commercial credit score, a Paydex score. Experian does a credit score for businesses. So you should investigate that and maybe look into doing some of that in the future. And I could be happy to share those videos with you. Anyways, that's most of what I had to cover. And here's what we covered today. Some recent closing, basic questionnaire. We covered most of the items I addressed. We went over projection-based loans. And I'm going to give you some examples of what I've seen priced out recently. So I had a customer or client want a quote on, she was buying 2 properties. She had 740 credit scores. She was looking for 80% financing on a projection-based loan. And the projection-based loans at 80%, she got a 30-year fixed quote at 5.22. If she went to 75%, it's probably about 5%, about a 25% basis point drop from 80 to 75%, 30-year fixed, 5-year declining. She can get better rates of terms if she went into a 5-year fix or 7. And there are some interest-only options. So oftentimes that's a way to go if you don't want to go into a 30-year fix and you're trying to get a little bit better rate. And here's something that I do. I always ask you what the long-term monthly rental income would be, because if it would qualify from a debt service coverage standpoint, I don't necessarily need to do the projection-based loan. I could just put it into a different portfolio loan program and the pricing is better, a little bit better. So I'm always asking, what's your annual projected short-term? What's your long-term, or what would it lease for on a 12-month lease? And sometimes we go that route. And if it's, we do an appraisal with an attached rental survey. And as long as the rental survey is in the ballpark of where you say, we can use that from a debt service coverage standpoint. What's the best way to check your payback score for free? None of Jaspreet, none of my loan products right now are looking at your payback score. You can go to DNB. I think there's a free way of going. Dun & Bradstreet, Google Dun & Bradstreet. There should be a free way to check your report there. Where I think the Paydex and the Experian come into play is if you're trying to get you can actually build your business credit to the point where you don't necessarily have to guarantee that as a person. You don't have to do a personal guarantee. So that's the goal, is to build business credit. There's unsecured term loans too. So you can do business unsecured term loans. They'll do lines of credit if you can show that your business returns, like for the last 2 or 3 years, are very solid. If you've had a business for 3 years and you're actually making money, and you can show that, you can do full document loans for your business and get up to $500,000 lines of credit if your global cash flow is there. What I did with mine, I had a couple entities and I just went in and got a few no-doc kind of unsecured lines of credit at a bank. There's some banks that are more favorable for business credit too. There's groups on Facebook too. So I'm always studying that myself, like what banks have the highest probability of, where do I want to open business bank accounts? There's an art to all of this. What are the transaction costs or points? Depends if we're doing projection-based, bridge loan, whatever. Usually there's at minimum a 1% loan origination fee it's usually 1% to 2% total fees between and then there's different lenders have different admin and doc fees, but you're usually about anywhere from $1,000 to about $1,750 in total lender fees besides points. And this depends. I mean, this is just kind of cookie cutter basic outline, but that's kind of like where the fees are. Sometimes we're able to do on bridge loans, where you might go get a quote and they're 2%, and we're maybe able to do it at 1.25% or 1.5%. It just really depends on the scenario. I usually can be competitive. What I find out there in the market, perfect example, a gentleman was buying a property and he also had a free and clear property, and he needed $975,000 plus about another $250,000. And between the free and clear property and this property, I did one loan, and I'm securing one loan against 2 properties. He was getting some quotes from other lenders, and the other lenders, there was a lender fee plus a broker fee. And they were trying to get 2 or 3 points, and I was able to do it for 1.375 total points. So the reason I'm pointing that out is listen, we gotta make win-win situations. And so what I try to do is get you the best rates and pricing I can. Period. That's what I try to do. Obviously, I have to make money. My business has to make money, but depending on how labor intensive the deal is, I'm very fair, because at the end of the day, there's cost, right? It's not the cheapest money, so we try to make a win-win deal. And because I work with a lot of different funds and I have correspondent relationships, I know where to get the best pricing for that unique scenario. So I'm usually able to make it a very competitive deal, and I'm usually able to win the majority of deals. And so that's really my value add position, is that I feel that my knowledge in financing wins me the deals, because I can take somebody that was having trouble financing something, I can figure out ways of doing it. And so I help business owners buy businesses. I help business owners build self-storage facilities. I have help businesses get construction loans for assisted living facilities. I have people right now that are buying residential care homes and things like that. So I have a pretty broad knowledge of lending. And so that's what I do all day. And sometimes I'm able to figure out things because I network, and I have banks and non-bank lenders that I work with. And I'm a direct lender on a few products, and just been doing it for a while. So the deal that came in the other day, he was shopping with another lender, and I knew I could get it done with very minimal work. So I work with the borrowers. I say, I don't want to, I want to price things competitively for everybody, right? I understand this is a business for me. It's a business for you. Where can I get you the best deal and be very competitive? And that's how I win business. And I'm not afraid to just say, hey, if you bring a deal, if you have priced it out with another lender, I'm going to simply say that's a great deal. Go with it if they're going to deliver. I have one guy, for example, and I gave him the quote. It's in a kind of a rural market in the Tennessee mountains, and I try to quote and say, listen, we can deliver here. If the BPO comes in higher, we can do a little bit higher leverage. We'll definitely do it here, subject to clean title and all that stuff. And then he's getting quotes at higher leverage. The fact of the matter is that I knew the lender he was going to, and he was trying to close in like 10 days. And there was no way this lender is going to perform because I personally refinanced a couple of my properties in the past with this non-bank portfolio loan. So when you're buying a deal and time is of the essence, meaning that you have a contract and you need to close by the 15th, if you don't perform, that seller doesn't have to take your contract, right? Like I've seen people lose deposits, it happens, right? You have a contract to close escrow on a certain date. Doesn't mean that they can't cancel the deal if you're not performing. At the end of the day, people call me because I'm going to deliver. And don't get me wrong, there's a lot of things that are out of the control, right? There's appraisals that don't come back at what the people think are going to come back. The ARV, if I'm doing a construction or multifamily bridge loan or something like that, the sponsor, the borrower's idea of value comes back low. I mean, we got to do as good borrowers and sponsors, we got to do our homework, right? Like we got to try our best to make the deal go smoothly. I had 2 years ago, or a year and a half ago, before I moved to Las Vegas. So yeah, it was about 2 years ago. We did a flip and we were setting the kind of price point in the market. And an end buyer was buying it, and we had it listed at 5. Their offer was 550. It was a very hot property. It was multiple offers, kind of like we're seeing right now. Still the same thing. And when the appraisal came back at 500,000, and we were selling at 550 was our contract price. So they tried to say, well, he can't bring in the additional 50,000. So we basically paid. We said, listen, we're going to pay for a new appraisal. So we had to kind of reverse engineer it. Of course, we wrote a letter of opinion, why the value came in low, and here's some comps that, at the end of the day, we ended up getting it reappraised by another appraiser and appraised that purchase price. So you got to just be aware, of all these things. But if we didn't have the expertise to navigate this, we probably would have, either had to put it back on the market or had to reduce our price down. So listen, as investors, we just have to be very detailed in our assumptions of what the revenue is going to be on these properties, realistic with what revenue is going to be, and make sure we're looking at an annual basis and cross check it. I was playing around with AirDNA and Mash Advisor on my house here in Henderson, and one was like 75,000 annual revenue. The other was like 90,000. It was a pretty substantial difference. So it's just really kind of honing in and looking at, what's the average occupancy level per month? Because right now, I do think we're in a little bit of a kind of a bubble of travel. I mean, do I think STRs are here to stay? Yes. But I also think, and we talked about this yesterday on a podcast, we do the Vinny and Bo show, and Vinny always talks about stress testing your multifamily properties because he's a multifamily syndicator. So I think we should look at that concept from Airbnb standpoint or from our STR standpoint, which means right now we're projecting 80% or 78% occupancy, whatever we're projecting, right? Well, we need to be stress testing these properties with like a 20 to 30% drop in occupancy levels. And I think that's a good takeaway for everybody. Stress test these properties. If you had a 30% drop in projected revenue. What does that do? Are you still cash flowing? Does it make sense? So when you're analyzing these properties, you have a realistic expectation, because I'm watching a lot of my friends absolutely crush it right now with their short-term rentals. But what happens when we just came out of a year and a half and we're still now dealing with COVID, right? So there's kind of like a weird thing going on, and hotels aren't as occupied as they once were. But will they come back? What are they going to do to kind of counter attack the STR markets? So I think there's a lot to be said. So I guess the point being is, I think you definitely should stress test, your properties that you're looking at, and look at what these properties do historically, every month. So you have a really kind of good expectation of what the average daily occupancy levels will look like. And it's like a fine tune. I'm talking to a lot of really seasoned STR operators. And it's interesting. They've given me a lot of good insight on, how they're running their businesses, little tips and tricks to keep the occupancy levels up. And also at the end of the day, if you're doing it across the country and you're not there, cleaning company, the handyman, the turnover, all that kind of stuff, positive reviews versus getting some negative reviews. And then, the automation of your business, I think is important too. But transaction costs, going back to that, they vary. But, I'm happy to quote any deals you do have. I'm happy to sit down with you and give you some scenarios for financing options if you're looking to grow. The other thing too that's important, and there was a question, source and seasoning your down payment money. We don't ask for tax returns on non-bank stuff on these portfolio loans. We do want 2 months of bank statements showing deposit, down payment, and usually they look for about 6 months of reserves of principal, interest, taxes, insurance payments in the bank. So you need that post-close, meaning after you put your down payment down, you have those reserves there. So sometimes some of my investors, and this is where you got to be a little bit careful on how to document. Usually we can overcome anything, but these types of loans do not typically allow for subordinate financing. So some of my investors always get like a money partner and then they put a lien on the property. Usually you can't do it on these. So you got to be strategic if you're raising capital for these deals, because quite often you're not allowed any subordinate financing. So you can't have a gap funding partner fund the down payment. So you might want to look at some partnership agreements or some profit share agreements, or, I would dig into that if you're borrowing your down payment money. But just know that we're going to ask for 2 months of bank statements, all the pages. We want to see where the money is coming from. Sometimes we do allow gift funds if it's like a family member or so forth, but we need to know that up front. Some tips and tricks on rehab funding or renovation funding, obviously a detailed construction budget. Anytime you're doing a rehab, it's not just a vacant policy. You need course of construction, sometimes insurance and different things like that. So having your insurance agent up front is important to make sure your insurance is going to cover on any kind of renovation type project that's vacant. So having somebody good from an insurance standpoint. And most of these portfolio loans do require an impound account. So you will have to, when you're making payment with the lender, you do pay your taxes and insurance. So most of that's called an impound account or an escrow account. So those are all pretty much required on these type of loans. Not on the bridge loans, but on the portfolio rental loans. Anyway, we're coming up on the hour. I hope I provided you some good insight. I probably shouldn't have done this in webinar format. Should have done it as a interactive. And we'll do that next time so people can get on and talk about the businesses and ask questions and make it more interactive. It's more fun that way. Please subscribe. I do a lot of videos. I think I have almost 200 videos now. And also on iTunes and Stitcher, you can find the audio version, but I think the video might be a little bit more beneficial, especially on the interviews we do. Anyways, thank you so much, guys. Bye-bye.